Hello, everybody. Welcome back. In the previous video, we discussed what is derivative. We've seen that derivative is a contract that derives its value from an underlying asset, like stock or index. In this video, let's explore the different types of derivatives you'll come across, and more importantly, which ones are relevant for traders like us. To begin with, there are four major types of derivatives: forwards, futures, options, and swaps. Let's start from the beginning with forwards, the earliest form of derivatives. Before exchanges, before apps, before anything digital, trading was all about physical goods and trust-based deals. And this is where the idea of derivatives actually began, from a very real world that need to reduce risk and bring stability to business. Let's take a simple story to understand it better. Imagine that during 1870 in Gujarat, cotton farming is booming. The harvesting season will begin in November. A cotton mill owner in Ahmedabad needs 100 bales of cotton by December to keep his factory running. But here's the problem. It's July, and he doesn't know what the price of cotton will be 5 months from now. If cotton prices go up, he'll be forced to buy at a higher cost. That'll cut into his profits or make his finished goods more expensive. At the same time, a cotton farmer in Ahmedabad is also uncertain the price. He'll harvest in November, but the problem is, what if prices fell significantly? What if there is a bumper crop and buyers quote half the price? So both the buyer and the seller are exposed to price risk, which means they are vulnerable to unpredictable price movements in the future. If the price of cotton shoots up, the mill owner or the buyer of cotton ends up paying much more than expected and his cost of production rises. On the other hand, if the price fell, the farmer or the seller earns less than he hoped for and might not even recover his costs. So they come up with an agreement, which is called forward contract. In July, they meet and negotiate. The mill owner agrees to buy 100 bales at rupees 500 per bale, delivery in November. During August to October, the farmer grows the crop. Now he has confidence of his income. In November, cotton is harvested. Whether the market price is rupees 450 or rupees 600 doesn't matter. The deal is already fixed. The transaction happens as per the July contract. This way, the farmer and the mill owner can fix their revenue and cost, and both parties are protected from future price volatility. That's the core purpose of a forward contract. It is a private agreement between two parties to buy or sell something at a fixed price on a future date. But as simple as this sounds, it had problems. What if one party backs out? What if the farmer finds another buyer offering more? Or what if the mill owner disappears and refuses to take delivery? There was no third-party enforcement. These were trust-based deals, often sealed with handshakes or letters. And that's where things started evolving. To reduce the risk of default, traders began using middlemen, brokers, or informal community guarantees. Over time, in larger trading hubs like Chicago, London, and later Mumbai, people saw the need for formal contracts with standardized terms and trusted enforcement. This gave birth to the futures contract. It is a forward contract, but with safeguards. It was standardized by exchanges. Quantities were fixed. Expiry dates were defined. Margins were introduced. And most importantly, the exchange itself became the middleman, ensuring that neither side could default. So, from cotton in Gujarat to wheat in Chicago, the need to reduce price uncertainty gave rise to one of the most powerful instruments in modern finance. That is what we called derivatives. Today, you don't need to know your counterparty. You just log into a platform like Angel One or Zerodha, and you can sell a futures contract on Nifty with full confidence that the trade will be honored, all thanks to exchange-based systems that started with that simple idea nearly 150 years ago. Now let's move to the most relevant instrument for us, the options. Options are slightly different from futures. An option gives the buyer the right. but not the obligation, to buy or sell the asset at a fixed price on or before expiry. And on the other side of this trade is the option seller who takes on the obligation to fulfill the deal if the buyer chooses to exercise it. Now, let's understand why one party gets a right and the other takes on an obligation, and how this exchange is fair for both sides. Imagine you want to protect yourself from rising prices. Say it's the start of summer and you think the price of air conditioners will go up by April. A dealer offers you a deal. Pay me rupees 1,000 today. I'll give you the right to buy any AC model in my store at today's price. Valid until April. But if prices stay flat or fall, you're free to walk away. That's exactly how an option contract works. You, the buyer, pay a small premium upfront for flexibility. You get a right to buy without obligation. This helps if you're uncertain about the future but want a safety net. You're happy to pay for that privilege. Now, look at it from the dealer's or the seller's point of view. He's saying, yeah, I'll take on the obligation to give you the product at today's price, even if the market goes higher. But since I'm taking that risk, I need to be compensated. And that compensation is the premium you just paid. This is the logic behind the option seller's premium. It's like an insurance company collecting premium from people who may or may not file claims. And just like insurance, most of the time those claims never happen. So the seller keeps the premium and profits unless something unusual occurs. In the stock market, when you sell a call option, you're taking the obligation to sell the asset at a fixed price. When you sell a put option, you're taking the obligation to buy it at a fixed price. In both cases, you're giving someone else a right, and in return, earning a premium up front. That's your income as a seller. And here's the best part. Most options, especially those that are far away from the current price, expire worthless, which means no obligation and you keep the entire premium. That's why in this course, we focus on option selling. It gives us a statistical edge, income upfront, and the flexibility to manage our risks smartly. Let's take a quick look now at where you'd actually see these contracts. Open your Angel One app and go to the Derivatives tab. You'll see options listed by expiry date. Click on Nifty and you'll enter the option chain, a table showing strike prices, call and put premiums, volumes, and open interest. Each row here is an individual contract, and every contract has a buyer and a seller. As an option seller, you can sell one of these contracts, receive a premium up front, and if the market stays within your expected range, you keep the premium as your income. Now let's briefly touch on the other two types of derivatives, swaps and forwards. Swaps are contracts where two parties exchange cash flows, often used by banks and large corporations. For example, a company may swap its floating interest payments for a fixed rate to reduce risk. These are not traded on exchanges and are not relevant for retail traders. And as we mentioned earlier, forwards still exist today in over-the-counter markets, like in international commodity trading or currency agreements, but they're not available to trade through your broker or on the NSE. So for you and me, the real-world focus is on futures and options, especially options, because they offer flexibility, lower capital requirements, and, if used with discipline, a reliable way to generate monthly income. I think by now that you understand how these contracts are structured, we will discuss with more examples in the upcoming videos for better understanding and better clarity. Now it's time to dig deeper into the call and put options themselves. Let's continue that in the upcoming video where we break down what these two terms actually mean and how both buyers and sellers think about them. See you there.